Welcome back to Finweek Money Matters. In the latest edition of Collective Insights for the year, we look at the relationship between risk and reward and unpack risk in 4 different ways. Firstly, we look at what risk is, then we look at why it matters and what you need to do about it. And lastly, we explore a few ways in which risk is being modelled in a more informed way. Joining us for the conversation, Anne Cabot-Alletzhauser Head of the Alexander Forbes Research Institute, and Roland Rousseau from the Barclays Africa Group. Thanks so much for joining us. And perhaps we just start with you, the theme or the themes unfolding in the Collective Insights. How many of these have you done, Mark?
There's a quarterly edition this year because it's a anniversary edition, but we'll get onto that at the end of it. I think maybe if we throw it to Anne, maybe just to unpack some of the themes from this week's edition.
Well, it's risk, and yet I think what comes out at you in the diverse articles is how many different ways there are to think about risk, and risk in the eyes of whom? The investor, in the eyes of the asset manager, in the eyes of the insurer. And because it's such a complex thing to unpack, I think that many people don't really know how to get their mind around it. So when people are asked about what is your risk vis-a-vis investing, they don't even really know how to even start approaching the problem. And that's what I think that this particular issue is trying to address, all the different permutations of risk and how do you approach them, what do you do about it?
Do you think we forget about risk when the market is simply flying at the moment? I mean, you get 15-20% in a year. Does anybody care what risk is? And maybe this is a question for Roland as well. Like, the simplicity, I'm a retail investor, I don't really worry about, I look at my statement and it says I do 20% in the year, I feel clever. But broader as an industry, do you think that the professional money managers have a good appreciation of risk, or do they get caught up in exactly the same trap of looking at a great return and they forget about risk in the process?
Well, the irony is that the risk is actually the responsibility of the end investor, not the fund manager. Although they pay to look after it, the risk is still taken by the end investor. So there's this old adage that in the markets we blame the markets when we lose money, but we take credit when we make money, right? So there's that skewed perception of what actually drives our portfolio. And the scientific research shows unequivocally that 80 to 90% of what happens in your portfolio is not due to the manager you've hired, it's due to the environment and the risks out there. So we focus very much on return, and that's what you see in your statement. But what we don't understand is how did you get to that return? So we choose managers at the top of the performance rankings, but often those are the managers that just took the most risk. And you find also the fund managers who take the most risk at the bottom of the performance rankings, they just got unlucky. So the best manager somewhere in between.
Is it a uniquely South African problem in that we see a lot of, we have a very concentrated market. I mean, essentially you have everybody buying the top 40 or top 80 shares, and maybe you've got a small cap portfolio, etc. There's a little bit of diversity. But is it something that's unique to South Africa, or is it a situation that you see playing out across the globe?
Well, I think Anne would agree with me that it's a global phenomenon. Is we don't benchmark skill correctly. We just look at the return. What we should be looking at is how much risk is taken relative to, how much return is generated relative to the risks that are taken. So if somebody's taking more risk, then they have to generate more return over and above that if they're determined to have skill. I don't know what your view is, Anne.
Well, you make a common mistake of a lot of people when they think about investing. Sorry, Mark. And that is to think of investing as simply a tool to just give me highest return. But actually it's an incredibly flexible, what would you call a skill set that you can use investing to achieve any number of different outcomes. So one of the outcomes I might want to do is to replace my income stream when I retire because I won't be paid by my employer anymore. Now the interesting thing about trying to achieve that objective, and it's one of the comments in the article that Dan Akers writes here, is if I'm heading towards that objective, my income maximization on retirement, it's a very different objective than just give me the highest possible return that you possibly can. Because what I don't want it to do is to fluctuate away from that cost of annuitization when I retire, that I have to, that purchase point of the annuity. If it fluctuates away from there, then my buying power gets severely impacted. Now, unless you understand that as being the risk, you fall into the trap that you just go and follow any investment strategy that they say, oh, this is a risky one, this one isn't a risky one. So risk is in the eye of the beholder to the extent of where do they want to go and how prepared are they to deviate from that end point in the path there.
But don't we reward that when we say, well, here, you just a simple unit trust fact sheet, and it's going to show you benchmark, and anybody's going to pick whatever their benchmark that they can beat, and then they're going to say, look, we outperformed it, and then that will be how the product is then sold to the end investor.
That is exactly the problem, is that the benchmark is not a risk-adjusted benchmark. The benchmark that is put into a fact sheet is a generally accepted benchmark for that category of funds.
True.
The true definition of skill is not did you outperform the benchmark, it's did you outperform the risks you've taken. Because I can outperform any benchmark by taking on additional risk, but that shouldn't be deemed to be skill, because I could lose all your money. And we don't do that properly when we benchmark.
But there you've got a complete mismatch between the risk that's put on a unit trust and why an investor would invest in the first place, because they're trying to get to a certain objective, which is a completely different type of a risk problem.
It just sounds so scary for the retail investor. I mean, even if you're trying to unpack it, it's just not hitting for the lay person, which is your retail investor out there. So how do we unpack it for the man in the street who is starting to invest, who is saying, right, how do I look at this term called risk without putting the terminology that we do as professionals, or as you do as professionals, to it, and say, these are the 4 points that you need to look at. Is there a way to simplify this discussion?
Look, there are probably things overseas that we don't have here that could help in terms of the transparency. You have independent kind of service providers that can, and there are lots of surveys in the unit trust space, but what you really need to look at is a simple rule, is to say, is my fund more volatile than the benchmark it's compared to? If it is, my fund is more risky than my benchmark, it's not appropriate.
But then there are a lot of fund managers out there who say that volatility does not equate directly to more risk.
Yeah, we're mixing up a whole bunch of different concepts of risk here.
The most basic definition of risk is volatility. But if you use a rule, and most people are invested in balanced funds, so they have CPI plus 3, 5 or 7 as their target return. I don't call that a benchmark. It's a requirement that you want to meet. But you can easily have a fund that outperforms CPI plus 3 by just having a high equity. That's why I invest in equities, because they give you an inflation hedge over time, right? So that's not skill, that's just high equity risk. So we need to understand that. So if the benchmark isn't volatile, but your portfolio is volatile, you've got to be careful.
Then you are taking on more risk.
Exactly.
I think there's a much simpler way. I think by using the word risk, you're right, we're scaring off investors. And what we really need to be doing is talking about what's your target? What are you trying to achieve? And very few investors sit down and think about that first. And you start there and you say, what do I need to achieve in terms of the growth of that capital, or the maximization of that income? If you understand that, and then you ask the question, how much time do I have to get there? Now those two elements really indicate what type of investment you need to go into, because they give you a sense of what asset classes you should be in, and then they give you a sense of how much variability you can afford to have around that objective.
I mean, I look at this and I think the fund management industry itself is at fault here, because when they advertise,
it's either you or the journalists.
Well,
or the lawyers.
This is why I'm going to ask this question. When the industry advertises their products or unit trusts, they focus on, 1, I've been the benchmark, 2, my returns have been so much over the past 3-5 years. And essentially that excites me as a retail investor. Ooh, I can actually get 20%.
You've hit the nail on the head, and the reason we have this problem is that we incentivize. So I wouldn't say it's the fund manager's fault. I would say it's the people who are paying the fund manager's fault, because they're incentivizing the fund manager to generate a high return. In fact, we pay you a performance-based fee the more you outperform. What does that mean? It's encouraging the fund manager to take additional risk, because how are they going to outperform by more other than by taking additional risk? So we need to change the incentivization model.
Do they now take the time to actually say, now that I've taken additional risk to achieve these high returns, do they take the time to actually go and explain to the retail investor that actually this is now what is happening?
As long as they beat the benchmark, they're happy, right? So that's generally the marketing.
Yeah, but this is where, in a low yield environment, the game's going to change, because suddenly there isn't that room to maneuver without actually communicating and taking on higher risk with higher costs.
That's why these fund management companies are marketing a longer term kind of invest over time, wait, don't do anything, and you'll see the returns coming through. So they're actually encouraging the investors not to chop and change.
Okay, but how does that marry, and we've spoken about this quite robustly before, how does that long-term view marry with the short-term nature of the fund management industry in terms of the visibility? The rewards are made, best performer 1 year, 2 years, 3 years.
Well, I think probably, I've often thought what we now need to do is start putting rewards out there. I mean, I listened to, was it Rosemary Hunter the other day at the UNPRI launch, or actually the Sustainable Investment launch, that's what it was. And she said, forget this Raging Bull Award. What we really need is a Raging Rhino Award. We need to reward people who can come up with ways to keep people invested over a long term, that understand that as the more you stay, the better the incentive becomes. So how do we reward people for those ideas? And all I could think of at the time was that Financial Times competition that they had about 10 years ago. I don't know if you remember it, but they got a big government fund. It might have been coal industries or something, not government, industry fund, to agree to hand a mandate over to somebody for a 20-year mandate for a several billion rand fund. Whoever had the cleverest idea of how you could take that several billion rand fund, billion sterling fund, and keep it invested for 20 years and maximize your return. And I just thought that was a brilliant idea. Now we got to come up with the idea for South Africa. Over to Finweek. Let's have the Raging Rhino Award.
Look, I mean, I agree with you. I think that, and I remember we debated this last year at the World Cup of Investing, but we have such a poor investment culture in South Africa anyway. I mean, yes, we have 900 odd unit trusts and that kind of thing, but it's only a tiny portion of our population. A lot of it's an easy win for an asset manager to say I'm number one and I'll attract some money into it, because what are people going to do? The natural reaction is I want to go with the best, and best is judged by what is your investment performance.
It's the law of small numbers.
The irony is that the best don't stay the best.
Sure.
That's the law of small
Exactly.
numbers.
There's lack of consistency, which makes it so difficult to decide where to put your money, because you can't judge from the past as to what the future is going to.
But that's why you need to not look at the return, you need to look at the risk-adjusted return, because that's more stable. So if you can generate a return after risks, you probably have something. Whereas if you're just looking at return, it could be
anybody's guess and could be
luck
wind.
rather than skill.
That savings culture Mark is talking about, over the past few years there's been changes. There's been an emerging trend of money not actually going to the fund management industry, but to informal savings, things like stokvels, etc., etc.
You trust your neighbor more than
absolutely.
These big guys down the street.
The Old Mutual Savings Monitor says over the past 2 years, it's actually grown up to about 48 billion of money that's just sitting somewhere under someone's mattress and simply gathering dust. And I happened to speak to Investment Solutions about this problem, and they're of the view that over the years, because of the scandals from Fidentia to Shemex, etc., so much money has been lost. People are left with nothing. So it's a trust issue. How is that now? Throwing a spanner in the works.
Well, I mean, who do we trust, right? I guess the only people we can trust are the people closest to us, but I'm certainly encouraging people not to invest informally, but to go through a regulated kind of environment, right? You need to have some kind of formalization and standards and rules that are abided by.
Yes.
And the role of the actual advisor in this, because again, it's very easy to pull up a fund fact sheet and say, cool, I won the award last year, give me the money, do advisors understand the concept?
We arrest those guys.
Do the advisors...
we are glad to know that.
Do the advisors actually understand the concept of risk-adjusted return? Because I think that that's where the flow is. That's where the majority of the asset management flows come from.
But that's why I go back to my simple recipe. Forget the fund fact sheets. Start what the financial advisor should be doing is saying, here's that target. Risk is defined as the risk of not meeting that target. In that case, the fund fact sheets become almost irrelevant. Because
that's not how they're incentivized.
Well, we're going to take care of that too.
We're going to hold you to that.
I've been counting on the government to step in here. But quite seriously, meeting that target is about an asset allocation decision. And it's about
which is a risk allocation decision.
Which is a risk allocation decision, right? And we've been confusing the fact that risk in the benchmark itself has risk. The more equity in it, the riskier that benchmark becomes, that type of thing. So your financial advisor should look at the risk of meeting that end target and keep reporting on how you're doing on your route to that target and how much deviation there is. His job, pick the strategy, pick the asset class. Managers are relevant.
Okay, very, very quickly though, just you mentioned government, and obviously you're going to become a bigger and bigger player in the savings industry. Now, let's say I'm a retail investor and I'm saving through whatever government structure, and they say, all right, let's pick a number, and they say they give me 6% per annum. And I look and I say, but it doesn't sound so great when I'm looking at somebody else's return outside of government, but let's say the government's got a better risk-adjusted return.
Well, you're assuming they're going to get into the pension fund management business, which is what they're quietly trying to avoid like the plague. I think they realize that's not a winning strategy for them.
But the question is going to be, let's say that it goes through government, and government gives you a less risky return, but they keep your find ways to manage your savings over that 20-year period. To
begin with, okay, remember what that savings is. That's your tax-free, that's your freebie from government. Now maybe it's not going to be tax in the future as the incentive, maybe it's a matching strategy the government goes for. But it is government's gift to you. And therefore what they've calibrated is how much do those people need to earn so that they stay off my back when they retire. They're not going to try to give you something that's so onerous that now they've got a whole bunch of homeless people on the street. So there's an actuarial concept that goes into whatever they determine. You have the freedom to go and take whatever money you want and go and put it in something else that won't have that benefit, that matching or that tax incentive. That's your problem. They're not telling you can't do that. But they are telling you that this is what we've determined you'll need to.
I think where government does help, and I think it would support your big hobby horses, that it's the time you spend in the market that's important. So if government can force you to stay longer in the market rather than you cashing out and going on a cruise and buying a fast car, you will avoid a lot of these problems.
In fact, there's an interesting comment the industry's made. They've said, we'll cut the costs, we can cut them as much as 50%. If you guarantee preservation and you guarantee continuity, because that is our biggest, the biggest cost we have is distribution and keeping people incentivized to stay invested with us. But if you force it, then we don't have to go out and do all that silly nonsense.
Thanks so much for your time. Thanks to Anne Cabot-Alletzhauser from Alexander Forbes and Roland Rousseau from the Barclays Africa Group. Time now to befriend the trend. The trend this week, gentlemen, is
executive remuneration using shares. So we looked at
what Chris Becker's been doing.
Well, it was a perfect starting point. I mean, I do think it's a very interesting thing. We talk a lot about. I think there's a lot of frustration when you look at things like the Marikana issues, and people look and they say, "But look what the executives are taking home, and look what the workers are taking home." And what's very interesting is you often talk to guys about this concept of ownership. Do you actually own a part of the business that you work in? And a lot of people are not prepared to make that investment in the long run. But you also look at it like the gold mining industry is quite topical at the moment because a lot of them are incentivized on options basis as opposed to buying the physical underlying shares. So they become jockeys for the share price. And you know, Piet Viljoen said it the other day when he was talking about this RCM vehicle that he's created. There's no options, there's no ghost things, there's no collars, there's nothing. This is simply it buys ordinary shares in the underlying business. And I think you're going to find that's going to become an increasing trend within executive remuneration. Is there's not going to be big performance bonuses. You're going to be tied in for the long term and say your goal.
Put your money where your mouth is. Put your work where your money is.
Perfect. And I think that's the reality. That's where the wealth is going to get created. So I think that if you're smart and you start negotiating in the long run, look for some decent underlying shares and buy the business.
Interestingly, Sipho Maseko, who's now heading up Telkom, and Jacques Kinderhitter, same thing. They're starting to invest in Telkom themselves, and suddenly the investment community is starting to think, well, if management is going to back this stock, perhaps we can unlock value.
Yeah, Ketso Goran is doing the same thing at PPC.